accounting deals with historical facts, things that have happened that affect the financial health and the financial aspects of the business. It can be selling something to someone, it can be buying something from someone, it can be borrowing money, it can be receiving money from shareholders or investors, but it's everything that has happened from the beginning of that corporation's existence to the current date. Now, finance, on the other hand, deals with how do I fund my business? How do I get the requisite capital into my business so that it can grow? And let me give you an example of the difference between the two. And let's talk first about a company that builds bridges. Big business, long-term business. It enters into a contract to build a bridge. Well, while that contract has a dollar value stated in it and it talks to when something will be completed, the minute that contract is signed, from an accounting perspective, nothing's happened. From a financial perspective, something has happened. From a financing perspective, something has happened. Which is to say, someone committed to pay money to have a bridge built. I, as the business owner, must now figure out how to build that bridge. And I must pay my people before I get paid by the person who wants the bridge built. That is financing. That takes into account prospective activities and how will money flow into the business and out of the business to make sure I can accomplish that prospective activity. So, the minute I enter into the contract, the accounting department has done nothing and should do nothing because nothing has really happened from their perspective. For the finance department, on the other hand, a big event has occurred. I've contracted with someone and I've obligated myself to build this bridge. I'm going to obligate myself by hiring people to build the bridge, and ultimately I will have to pay them. So the finance department may look at that contract and go out and talk to investors or lenders about that contract and ask, will you give me money so that I can build this person a bridge and make a profit? That's what the finance department worries about. The accounting department simply worries about what happens the minute that money comes in. So the minute the money comes in, either from an investor or a lender to start buying the materials to build the bridge, the accounting department gets involved. And what the accounting department is designed to do is to simply reflect how that money has been received, how it's been spent, what it's been spent on, what's obligated to be paid by my customer who wants the bridge. So when you look at the results of the accounting department, sort of the financial statements that are produced, financial statements are always an historical look at the condition of the company. The finance function, which is looking prospectively, still needs all of those financial statements to help investors, lenders, understand what has happened when I've done this in the past. Have I shown I can do this at a profit? Have I shown that customers will pay me? Have I shown that I pay my vendors and my vendors will then come to work for me on the next job? So it's very important to the finance department to have very accurate financial statements, but the preparation of those statements tends to be under the domain that we call accounting. In order that these prospective lenders or prospective investors can understand what has happened, the accounting systems that are used and the accounting methodologies that are used are based on what's known as GAAP, Generally Accepted Accounting Principles. That takes the accounting activities from everything from a grocery store to a software company to my bridge building company, and takes all that data and converts it into a nice language that anyone can understand about any industry.